welcome to the next in our series of videocasts specifically designed to offer help and support and advice to our clients. And today's, bizarrely, might even allow you to sleep a little bit better. So here at Ultimate, we said before, giving our clients access to advice and experience from industry-leading organisations is a really important part of being that funding partner of choice. And we love success stories. So these bite-sized interviews might help you maximise your own success as you steer your way through the interesting times we've got at the moment. So I'm Adrian Stalley, Head of Partnerships here at Ultimate Finance. And today I'm joined by Keir Cox, Director of Operations for Purbeck Insurance. So insurance, I hear you say, don't switch off yet. Purbeck are the UK markets, and I'll read this bit to make sure I get it right. So Purbeck are the UK market's only provider of directors' personal guarantee insurance. It's a policy designed to protect personal assets that put at risk by signing a PG in support of corporate debt finance. So let me just start with a very quick personal story of why I wanted to bring this to you personally as well. That prior to joining Ultimate, I've sat in that seat as a business owner of an SME company. And I remember the first time I was asked to sign a PG. Yes, I believed in my business without a doubt. But I have a wife, I have two sons, I have a home. And all of a sudden that worry becomes very real. And as well as those businesses were doing, it was another thing that just keeps you awake at night. So we really do get it. And I wish I'd known about this type of protection then, and that was more my lack of knowledge than anything else. So now it might not be right for you, but it's really important we just share that these things are there. So Keir, great to have you on this call today, and welcome. So
thanks for having us.
Yeah, we've been discussing these sort of things for a while, and I know we've put some of our businesses in touch with you to have this conversation at arm's length because they wanted to explore that sort of peace of mind as well. But understanding what personal guarantee insurance is, what it does, what it doesn't cover, is really important. So put simply, what does personal guarantee insurance cover?
Yeah. Thanks for having me. First of all, obviously good to be here. It's quite simple. Obviously, like all insurances, it's there to protect against the unexpected. Obviously, we've had quite a few events over the last couple of years which have been unexpected. And quite simply, it's a policy designed to protect a percentage of a director's personal guarantee that's called upon post insolvency of the company that's taken on the debt. So we can sort of look at secured or unsecured finance. So on the secured finance, so stuff that's asset backed, so invoice finance, bridging property lending, hard asset finance. We can consider cover up to 400k. Of which we provide a cover position of 80%. On the unsecured finance, so the riskier of the two, where the PG acts as the only security, it's a 300k limit at the moment, and we sort of cover 60% in the first year, 70% in the second year, and then 80% in the third year and beyond.
Brilliant. No, I appreciate the summary. And I think you make a really good point there that this is nothing specific to what we do. Any director who is faced with potentially signing a personal guarantee could have that conversation with you. Is that true?
Yeah, absolutely. It's worth noting that we can also cover guarantees retrospectively as well. So for quite a lot of directors, they're still not aware that the cover's out there. So providing that the business and the proposal fits the bill for us, there's no stopping a current director with an existing PG sort of getting signed up to protect themselves.
Brilliant. I said in the intro, it might make some of the other business owners we talk to sleep better at night. So it's a great intro on that. So just picking back on a couple of things you mentioned. So just to be absolutely crystal clear, so it doesn't cover the full guarantee value, does it?
That's right, yeah. So it was kind of an important point when getting this off the ground with our insurer, Markel. So effectively, Purbeck acts as an underwriting agent for Markel. Markel are a 90-year-old global A-rated insurer, so the policy's backed by a good standing insurer. But they were quite keen to see that the directors sort of retained a significant enough percentage contribution to ensure that they were going to work with us if things started to not look quite so rosy. We didn't want essentially the policy to change directors' attitudes, obviously make them more essentially sort of risk or make decisions that they wouldn't normally have done had the cover not have been there, really. So that's kind of the decision making behind not offering 100% risk transfer.
And just to add in that, I mean, from a lender's perspective, they're sharing that it's important that directors, I'm certainly not referring to our clients, but directors are simply not passing that risk on, and it doesn't therefore encourage, let's just be honest, cavalier behaviour. So the fact it offers that sort of peace of mind is fantastic and can make the real difference between is it being viable or not. But everyone's still got a little bit of skin in the game. So the reassurance that it can provide to a business owner can be huge in that sense. And you mentioned as well that the cover, whilst there'll be a start point, in some cases may well increase over time. Again, not to that 100% level, but it can sort of stagger up. Is that correct?
Yeah, that's right. So obviously for the unsecured stuff where the PG is the only security, obviously the chances of commercial assets mitigating some of that loss for the director on the personal end of things is a lot smaller. So we naturally see a greater sort of claim yield on that sort of arena of lending, really. So it's kind of similar to a no claims bonus, I suppose, almost like a trust exercise. As we come to know the business, we sort of taper the cover up, so 60 year one, 70 year two, 80% year three. Typically speaking, these loans are reducing over time. So what you'll tend to find on those types of facilities is a reducing premium, but also kind of an increasing cover percentage as well.
Brilliant. No, I appreciate it. And obviously the insurance cover therefore speaks for itself. But I mean, does the policy cover any additional sort of benefits for directors as well?
Yeah, we do provide a couple of other features of the cover. So a big part of the service that we provide to our clients is the proactive support and assistance service. So similar to kind of like a bad debt protection style insurance, where you need to notify of a material bad debt position. We have a couple of instances where directors would also need to notify us. So if they were starting to feel concerned about sort of general cash flow of, you know, material bad debt, there was a legal issue that could present solvency issues for the company, with a view to sort of trying to help essentially turn the issue around if we can. So that's kind of like the front end support and advice, and actually probably about 65% of the notifications that we receive are actually resolved without the need to move to claim. So it's quite a successful feature, the cover, in helping keep things afloat. The other sort of side of the coin, so the benefit for the director, is we offer a debt negotiation service. So we cover fees for a professional firm to essentially agree a settlement with the lender. So the view there is just trying to agree the most favourable outcome for all parties. And on average, we save our clients around about 20% through those settlement negotiations as well. So there's two of some of the other features that are aside from the insurance itself.
And really important, again, come back to the life as that business owner or director. I think these are really sort of good value adds. And one of the questions we get asked, obviously we're a finance company, one of the questions we get asked all the time in terms of what's the application process, how long does it take? So I'm sure that's probably no different in your world. So in the world of someone thinking, I'm interested in exploring this, can you just walk us through that application process and the time span to get a decision?
Yeah, I mean, most of our stuff is pretty quick in terms of a decision. So it requires the completion of an application form, which isn't particularly onerous. It's about 4 pages. So personal details, a bit about the company, the lending scenario, and then just a series of declarations, mainly tailored around the solvency position of the company. So we generally require a completed application form, a copy of the latest management accounts. Generally speaking, for most cases, particularly asset-backed ones, where we can afford to be a little bit sort of quicker because of that asset security in the underwriting, that tends to be all we need. Potentially on the larger exposure side of things, or if we, you know, if it's in a sector that we're not particularly keen on at the time, we might require sort of forecast, that type of thing as well. But I'd say the majority of our decisions, you know, providing we can have the form and the accounts, most of our stuff is turned around same day. And once terms are issued, then, you know, cover can be purchased instantly as well. So you can do that sort of with an underwriter over the phone, or we do have a 24/7 portal that the directors can access as well.
And that's fabulous to say. Again, business owners, directors, knowing where they stand, knowing what is an option is great. So the speed of that is really important. The question we get asked, probably only the question we get asked more than how long does it take, is costs. The same with everybody. I'm not expecting to go through tariffs and things like that, but in terms of just roughly the costs associated or the way the premium rates are calculated is probably a better question, just so at least people understand what they might be looking at. So could you shed some light on that?
Yeah, absolutely. So we've got 2 different rating structures for secured and unsecured. So obviously premium rates are subject to individual circumstances, but can start from anywhere between 1.6 up to about 3% of the guarantee sum insured. So if you had a 100,000 secured guarantee at a 3% rate, you're looking at a 3,000 premium. Then have to pay insurance premium tax on top of that, which is a 12% surcharge of the premium. So gross cost to the directors is sort of 3,360, and that costs can be paid monthly, so we offer a monthly payment facility, and then we do also charge an arrangement fee for the cover as well, which varies from about 250 up to £1,000 per policy, depending on what work we need to do to get things quoted. The unsecured side of things is a little bit racier, so it's a little bit pricier. So it's between sort of 2.4 to 4% of the guarantee sum insured. Again, same tax rates and arrangement fees. And in terms of kind of the decision-making process, we take into account kind of company credit scores. So we use a few different platforms, primarily Credit Safe, but we do also use Fame system as well, which is Moody's credit rating engine as well. We'll also sort of take into account kind of balance sheet ratios, kind of profit and loss performance as well. Track record and experience of the directors is another thing as well. So we do also cover startups, so less than 2-year businesses as well. They're not out of the scope for us. We just have to do a little bit more for it. So yeah, we take a look into that. Obviously, directors track record, and then generally speaking, it's a premium rate that's calculated off the back of that.
Brilliant. And going back to, I mean, all insurance policies is about the peace of mind, is about protecting yourself, those sort of things. So I think going back to your earlier answer about the speed of getting that decision, for directors, for business owners to know what they need to know to be able to weigh up those decisions very quickly, I think is really important. So that's fabulous. Appreciate you doing that. And in terms, you touched earlier on the claims, in terms of the number of claims, in terms of, more importantly, the percentage of claims you pay out. You touched on that a bit earlier, but just elaborate a little bit further on that, please.
Yeah, I think my favourite response when it comes to sort of discussing the claims side of things, we pay out on 100% of all valid claims. But I did sort of prepare a little bit of data on this front just to give a bit of peace of mind front. So because of the notification element of our claims, and because they're often tied in with the insolvency process, they can often have quite a long tail to them, because insolvency processes can sometimes take years. But sort of some of the headline stats that would be kind of worth sharing. So I mentioned earlier, notification front. So 65% of notifications that we've received in the sort of 5.5 years we've been doing the cover resolved without moving to claim. 11% of notifications are still open but have not yet moved on to a claim, and then 24% have then moved on to the claim. So of the claims that we've received today, 21% ultimately did not need to make a claim on the policy in the end. So by the time that the assets had been allocated to the debt and we'd finished negotiating the position, actually the directors didn't actually need to submit a claim on the end. 29% of the claims are still open and in progress. So again, just tied into the process, and most likely they'll be sort of due to be paid out shortly. 40% have been paid and closed off. And then 10% were not paid, as essentially either the director cancelled the policy, or if they're paying on a monthly payment option, they'd not kept up with their premium payments, unfortunately. So obviously naturally need to pay the premium to make the claim. So it probably works out in total to, if you factored in the percentage of settled, those moving to be settled, and obviously those ones that we would have settled on had there ultimately been a balance to pay, probably about 90%, I think, of things that move to claim end up getting paid.
Yeah, I really appreciate transparency as well, because it all helps that sort of peace of mind and just awareness. And in terms of as a business, like I said at the start, you're very much a specialist in this area, but do you offer any other sort of products or services?
So at the moment, we're the sort of one-trick pony. So we just deal in the PG insurance. So we've got two variations of that at the moment, which is the core product. So for the working cap, or the finance end of things. We also do personal guarantees attached to solicitors' professional indemnity insurance. So nowadays, a few of the insurers have started asking for PGs to cover runoff premiums. We're also looking at kind of the variations of the products. So we've seen a lot of demand in areas like commercial rent-related PGs. So for premises landlords asking for guarantees, trade credit supply lines, so for your haulage companies on your fuel cards, that type of thing. So we're looking into it's all still very much PG focused, but obviously other types of PG that we currently can't cater for. So as it stands at the minute, we've got two, and we're working with our insurer hopefully to sort of release another couple over the next sort of 12 to 18 months, hopefully.
That's reassuring as well. I mean, you're specialist in that area, to make sure that the focus is there. That's great. And I'm going to finish where I started, which I introduced you as, I think, the only UK provider of these sort of services. So the obvious question is, why is that? So why do you think there are no other providers in the marketplace?
Yeah, I think it probably sort of heralds to the to the economic climate, I would say, that we've been on for the last year. So, you know, we entered the market in 2017, obviously. So we initially were trying to raise awareness for a product, and obviously dealing with the initial waves of the Brexit referendum. Then obviously a couple of years of relatively smooth sailing and growth, obviously as smooth as it can be with any new product. Then obviously COVID hits, so that was a difficult time for us. Like a lot of insurers, we had to stop writing new business for a period of time, and then obviously now we've got sort of record levels of inflation and a lot of doom and gloom about, you know, recessions and so on and so forth. So I think because it's been such a choppy climate, it's kind of put off a competitor actually entering the market space. I almost think they're perhaps waiting for I guess a more stable climate to enter. So I don't think, I'm not under any illusions that we'll remain the sole provider for any period of time, and, you know, almost kind of relish the entrance of a competitor, really, so we can sort of really prove ourselves. But yeah, I would say it's probably the climate more than anything.
Brilliant. Anyone coming into the market's got a lot to catch up with, because I know our clients that we've at least put in touch with you have been very well serviced to that. I mean, that's been great. Keir has been brilliant and really informative, so I really appreciate that. So thank you for taking the time to talk through the availability of personal guarantee insurance. I hope our clients found it useful as well in that respect. And if any of our guys want to talk that through in terms of their own interest, obviously you've got your relationship manager you can come to, and they'll more than happily put you straight in touch with Keir and the guys at Purbeck, because again, we can only speak highly of the involvement we've had so far. So I hope everyone's found this video cast very informative, as very much part of our passion to really add value to our clients. And on that note, thank you for listening.